In this presentation, we will work a problem related to capital budgeting. We're going to be using some of our core calculations, that including the payback period, the accounting rate of return, and the net present value calculated in a few different ways. 1, with the use of the tables, 2, with the use of formulas, and 3, with a more extended use of the formula so we can compare and contrast different methods for using those formulas. Information up top, we're going to have a new machine for a new project. In other words, we got a new project coming up. We need a new machine for that project. The cost of the machine is going to be $499,000. Useful life 4 years. Salvage value we're saying is $23,000. The expected annual returns are going to be $1,880,000. Direct materials $455,000 for our project. Direct labor $670,000. Overhead not including depreciation $336,000, selling and admin $174,000, and the income tax at a rate of 36%. First thing we're going to do is calculate the depreciation. We're going to use a straight line, a simple straight line method for the calculation of the depreciation. We have the cost up top, useful life, and the salvage. That's what we need. We're going to do that down here in the blue section. So we're going to do this fairly quickly because depreciation straight line should be fairly straightforward at this point. If not, take a look at the depreciation presentations. We're going to say here's the cost. It's going to be equal to the $499,000. Then we'll take the salvage value. So the salvage value is going to be equal to the salvage value of the equals $23,000. We're going to subtract those two out, and that's going to be the amount to be depreciated. I'm going to call it the depreciable amount. This is going to be the $499 minus the $23,000, the amount to be depreciated, the depreciable amount. And then we're going to take the useful life, which we said was 4 years. So I'm just pulling down the 4 years from our data, and that's going to give us the depreciation per year on a straight line method if we divide that out. So we're going to say this equals the $476,000 divided by the 4 years. That's going to give us our $119,000 depreciation per year. Now we're going to take a look at our expected net income with relation to the project. So we're going to start off with revenue, and we're going to say that that's going to be equal to the $1,880,000 of revenues. Now note, when we consider this, we're considering the net income, and then we're going to have to consider the cash flows as well. And oftentimes we're considering the cash flows as the relevant type of item. The reason the net income is important also is because of the calculation of taxes, however. The taxes will be an effect that is going to be a cash flow type of effect. It will be affected by something like depreciation, even though depreciation is not a cash item. So that's what we need to calculate as well as we go through this process. So then we're going to say expenses. So the expenses are going to include, I'm going to pull these from the top, just saying equals, and pulling up the expenses is going to be the direct materials, labor, overhead, and admin. What I'm going to do is say enter, and then I'm going to copy those down or autofill them to fill in the rest. So here's that one. I'm going to put my cursor on that and then use this autofill button and drag down. Auto drives it down. Dr. Phil does the calculations. I went too far. I'm going to autofill back up and remove that last one. All right, and then I'm going to pull the numbers in for direct materials in cell B24. This equals, and then we'll scroll back up, and we're going to pick up the $455,000. Going to do the same thing here. I'm going to autofill this down. So we have the first number up top. We're just going to autofill that down all the way. So we're going to put our cursor on the autofill little square. We're going to drag it down, left click, drag it down. Auto drives it down. Dr. Phil does the calculations. Then we're going to also add to this the depreciation that we just calculated. So we're going to say, all right, the depreciation for the equipment is going to be equal to this $119,000 per year. That's going to give us our total expenses. I'm going to bring this out into the outer column. I'm going to format this a little bit. I'm going to highlight these items. This may be formatted for you already in the pre-formatted worksheet. We'll go to the Home tab. We'll go to the Alignment, increase the indenting, and then I'm going to put the total expenses, and we'll put that in the outer column. And we could indent this 2 times. Home tab, alignment, indent, and then sum them up. I'm only summing up the expense column here, so we're going to say equals the SUM, the sum of the 454, 455, the 670, and so on and so forth. Adding those up, that gives us the $1,754,000. And then we can get the income before taxes. So the income per year before taxes is going to be the revenue minus the expenses. Of course, outer column numbers is going to be equal to the 1,880,000 minus the 1,754,000 for the 126. Then we're going to calculate the income tax with the rate given. This is obviously a simplified tax because it's a flat rate that we're using here. So, which is often the case that we do to estimate what the taxes will be. So we're going to say the 126 times the 36%, which is going to be our tax rate up top in the data. Tax then being $45,360. Note that it was important for us to calculate not just the cash flows, but the other expenses, including depreciation, even though it's not a cash flow, in order to then calculate the proper tax, which will be something that will be a cash flow item that we need to take into consideration. So that's why depreciation is basically relevant here, and we can't just kind of eliminate it as something that's not a cash flow based type of item. And that's going to give us the net income. So we're going to say, all right, the bottom line is going to be the net income. That's going to be equal to the income prior to the taxes minus the taxes. I'm going to get rid of the double underline here by doing that. And there we have it. So there's going to be our income. So now we can think about that. Okay, so there's our net income per year. We also want to think about, well, what's our actual cash flow then? Because notice that this line item, although it is important for us to get to the proper net income amount due to the calculation of taxes, is not relevant with regard to cash flow. So now we want to think about, all right, well, how do we get to the cash flow number with relation to this project? Well, we could start with our net income. Once again, here's our net income. It's going to equal the $80,640. And then we're just going to remove anything that's not a cash flow item. And that's going to, of course, be the depreciation in this example. So we're going to say, now that we've used depreciation to get to net income, we are going to remove it. Depreciation reduced net income. Therefore, we're going to basically add it back in, or we are going to add it back in order to get the net cash flow on the project. That's what we're going to be needing. We want the cash flow for the project, not the net income. So we want the cash flow. There we have it, the $199,640. That's what we're going to use basically to present value, make our decisions on. So now we'll go through our different kind of calculations. We've got the couple calculations that do not take into consideration time value of money. Then we'll take a look at the net present value, which does. So the first one, of course, is the payback period. These are kind of like the quick calculations that we're going to put together to see if we want to go through the detail then of going to the net present value calculation. So these are kind of quick type of calculations that we will have. So we've got the payback period. We're going to take the cost of the investment. That's going to be the cost of the investment, and we're going to say that that is equal to, in our case, the $499,000. We can pick it up here, or we can pick it up top from our data. Probably better to pick it up from the data, but there we have that. And then we're going to say that the next item is going to be the annual cash flows. So the annual cash flows, which we just calculated up top here. So there's our cash flows. So the cost is this item. Just if you think through this, obviously the payback period is going to be the cost, how much we spent in year zero, this time period, divided by the annual cash flows that we're going to get back. And that's going to be how long it takes to give us the payback period. So in our case, the payback period would be equal to $499,000 divided by the annual net cash flow, $199,640, to give us 2.5. So the payback period, 2.5 years. So we should, in other words, within 2.5 years, get back to our original investment, $499. In other words, if we take $199,640 times 2.5 years, we're going to get back pretty much to our original investment. Why isn't it exact? Because of rounding. So if you go to the home tab, numbers, rounding. But it's an estimate, so we're good with basically 2.5 years, 2.5 years. Now note, of course, that doesn't take into account time value of money, but it can be a useful, quick type of calculation. Now we'll do another quicker type of calculation that doesn't take into account the time value of money, that being the accounting rate of return, the accounting rate of return. We're going to start off with the annual after-tax net income, which is going to be equal to the 80,640, and then we're going to take the annual average investment, and we'll do a calculation in the inner column of the annual average investment. We're going to take the assets cost. The assets cost is going to be 499. That's from our data up top, so that's what the original cost was. And then we're going to take the final year cost, which is basically the book value in the end of the year, which in essence is the salvage value, what it's going to be left at the end of the year. So at the end of 4 years, we believe it's going to be worth $23,000, the salvage value. So there's that, and then we'll have a subtotal. So we're going to say, all right, let's have a subtotal. We're going to add those two up. Add those two up with the sum function, SUM, adding those up. And then we're going to take that and divide by 2. Now again, this average might look a little funny because whenever we do an average on the balance sheet account, it's a little bit weird because we're kind of trying to see what the average is over a certain time period for an account that represents a point in time. That's why we often have this beginning and end time period type of calculation and then divide it by 2 to get the average. So that's going to be the average calculation. So we'll say the average, the annual average. I'll pull that out to the outside now. This is going to be equal to the 522,000 divided by 2. And that gives us the 261,000. And then we can calculate our accounting rate of return. So the accounting rate of return is going to be equal to then the 80,640 after-tax net income divided by the annual average investment. That's going to be 30.9. Again, this number can be useful, but it doesn't take into account the time value of money. Fairly quick type of calculation. Now we'll do the more kind of intense calculation. We'll do it in a few different ways. We're going to use the present value type of calculation. Now, the present value type of calculation we can use as long as we could basically break out the cash flows per year. We can use the present value type of calculation, and it's going to take into account the time value of money. To do that, we're going to have to use some type of rate, like a discount rate, in order to calculate the time value of money, this being the factor of the time value of money. So we're going to use the 7% here for our rate. So first we'll do this calculation and we'll use the tables over here on the right. So the common tables that we're going to have, and this is going to be common with accounting type of tests where they might have a limited calculator, and if obviously you don't have Excel. So we'll start with the table on a test purpose, and then we'll go to Excel, which is going to be the more practical format for most people as you're working through problems that will be dealing with longer net present value types of calculations. The first thing you want to note when you use the table, just remember that there's two main tables we're looking at here. We're trying to present value something, not future value something. So that means we're trying to take values out in the future and pull them into the present value. And therefore, so you can eliminate anything that says future value. And then there's two present value tables that you're going to be working with. One is the present value of 1, and the other is the present value of an annuity. So anything that has the same payments, so if you have any kind of project where the payments are the same going out, you can use the annuity table, and that's a little bit easier because it'll basically have one calculation. If we have present values that have different amounts of cash flows, then we're forced to use basically present value of 1, or we might have an annuity portion and a present value of 1 portion. And that's often the case with something like an investment, because if we might have a salvage value, for example, on this one, and so therefore we might be able to sell the equipment at the end for the salvage value, and we might calculate that within the cash flow, and therefore have an annuity based on what we think our income is going to be each year and a present value of 1 portion. So let's see how this would look. We're going to say, all right, we're going to be using our tables down here. We're going to be using the present value. So we're going to first look at the present value annual cash flows and use an annuity present value. Now we've calculated the annual cash flows up top. I'm going to say this equals, we're going to go up top to the cash flows, the 199,640. Then we want to take the present value from the annuity table because this is going to be the present value for the annuity. So we're going to get this amount then we expect for multiple years at 7% and the useful life of 4. So that's what we expect to happen. In other words, we're going to discount this and present value it, reduce it by 7% given the time value of money, because of the time value of money, if you would rather. So we're going to take the annuity tables, the one you're going to be looking at, and we want to take the 7%, and we're looking at 4 years. So 7% and 4 years, we're going to pick up this 3.38721. That's the number we want. So we're going to say, all right, let's go back over here, and we're going to pick up that annuity table, and that's going to be, once again, 3.38721, I believe it was. We've rounded it to 2 here. Note that I've included decimals to do that. Home tab, numbers, increase the decimals so you can see the decimal amounts. Then if we multiply that out, we're going to say, all right, here's the 199,640 per year times 3.38721, and that gives us 676,223. Now note, when you look at these annuity tables, you could get an idea of whether this is going to make sense to you or not, because obviously this amount, we're expecting to get that each year for 4 years. So you would think that if there was no time value of money, it would just be this times 4. And if there's a time value of money, then it's going to be something less than 4 because we're discounting it. We're reducing its value due to the time value of money. So it's going to be greater than 1, of course, because we're multiplying this and we're getting the same payment each year. But it's going to be less than 4 because 4 would be if there was no discounting on the time value of money for the annuity. So that'll give you kind of a ground to say, that looks reasonable. And we'll double check it in another way in a second as well. Now we can also think of the salvage value that we might get at the end of the project. We say, okay, that we could sell it at the end for the salvage value. And that's not going to be happening every year. That happens at the end of 4 years. So at the end of 4 years, we should be able to get another salvage value of, where was the salvage value? 23,000. So that 23,000, we think we're going to get that. Now we can't use the same table here. We're going to have to use a different table, which is going to be the present value of 1 this time, not the annuity. And that's the tricky thing. It's not a future value. We're not looking at future values. We're trying to present value things when we're looking at these projects. So we can eliminate the future value. We have these 2 tables. Now we're trying to present value this 1 payment that happened 4 years out, that's going to happen 4 years out. That means it's got to be less than 1 because it's 1 payment that happened 4 years later than now. So we're going to say it's got to be this table, present value of 1. We have the 7% that we're looking at for the discount rate, and we want to be picking up the 4 years. So 4 years, and that's going to give us the 0.76290. So we're going to say, all right, got to pick that number up over here. This is going to be the, once again, the amount of 0.76290. And we could add 1 decimal, home tab number, add a decimal, add a decimal. And then if we multiply that out, we got the 23,000 times that number. And of course, this number is going to be less than 1. This number needs to be smaller than the 23,000 because it's not happening. It's not multiple payments. It's not an annuity. It's 1 payment that happens at the end of the 4-year time period. So that's going to be then our present value of 1. Let's call it present value of the salvage value. And so then the total present value then is going to be the annuity plus the present value of the salvage. So I'm just going to add those 2 up. There's going to be our total in terms of present value. So we did it in 2 ways, 1 with an annuity, 1 with the present value of 1. Note, you can only do that with an annuity if the payments are equal. That won't always be the case, but we can always use the present value of 1 if we have to, and just discount them each year out, and we'll take a look at some examples of that. Now let's just take a look at Excel and do the quick type of calculation with Excel, which can do the same type of thing as these tables just did. So we can say, all right, let's use an Excel formula, and we'll take the annual cash flows again. We're just going to do the same calculation now using Excel. So here's the 199,640, and now I'm just going to use the present value formula using Excel. Couple ways you can do it. One way, if you're new to this, you could look it up in the formulas and actually look up and say I want to look up the present value, and you could type that in. I say present value, and then they're going to be looking for present value, and it should be something with a PV. That's the one we want. It says returns the present value of an investment. So we're going to say that's the one. So we'll say that's what we want. Now this is the format we can use as kind of interboxed instead of just a line formula down here. So we'll show these in two different methods. Note that we're going to be using the same present value function for the two types of present values, for an annuity or the present value of one. That can be confusing at first. Once you get it, it's not confusing, but it's simpler in a way, but it's also a little confusing. So we're going to use the same function for those two annuity tables in essence that we looked at. So the rate, I'm actually going to type in the rate because we didn't put it out in a separate cell. 0.07. The number, this is going to be the number of periods. Now the number of periods is in our case the number of years, and that's going to be 4. Now the tricky thing is the payment. In our case, in this scenario, the payment, we're going to use a payment because it's an annuity. So in an annuity, we use a payment. If it wasn't an annuity, as we'll see next time, we'll use the fair value. So this is the tricky part. In an annuity, it is what you would expect. We would pick the payment of the 199, or I also put it right here, the 199. And you can see it's actually given us the calculation down below already. That's going to be the 676. It matches this number, it looks correct. So I'm going to say OK. Now it usually gives a negative here because it's calculating the flow. I like to flip the sign and show it as a positive. If you double click on this, it'll show you the formula. We'll actually do this with relation to the formula in the next little section here. It gives us a little detail of the formula down here, down below as well. So we'll get into that in the next piece. I like to just put a negative in front of the P, in front of the formula, in order to flip the sign. So I'm just going to say negative of that formula, right? And that'll take that formula, flip the sign for it, and there we have it. So now we're going to do the same for the salvage value as we did up here. So the salvage value is that 23,000, and we want to basically present value it using Excel. And now we're going to use the present value of 1, which you would think would be a separate function, but it's not. But it's going to be a little bit different as we put the information into the function. So I'm going to double click on the present value again. Here's our formula, our data input screen. We're going to say this is 0.07 for the interest rate. The number of periods, is going to be 4. And then the tricky piece here is that we don't have a payment, because payment means that we're going to have a payment each year. We don't have any payments each year. There's really 0. What we do have is a future value at the end of 4 years. So we're going to say we want to present value this future value at the end of 4 years, not an annuity, which has like payments, things that are going to happen each year. So 0 in the payments. Then we're going to present value the 23,000 that happens at the end of 4 years. So we're going to say, all right, okay. Once again, it's a negative. To flip the sign, I'm going to double click on it, go to before the P, negative, and that'll flip the sign for it. And that'll give us our present value calculation using Excel formulas. Now that's nice here because it's nice and simple. However, it's a little tricky because if I want to know the detail, if I want to know if I'm right on this, it's hard to tell because I just kind of basically I'm completely dependent on this formula. So you might want to actually break this out. It might be useful to break this thing out and actually see the present value per year. And that's what I would typically do. I think it's the best way to look at it in any case. So you might want to break out the cash flows in this format. I'll show you a couple different ways to do this. So we could do it this way, year 1, 2, 3, 4, and then the total. Then we'll look at the cash flow each year. So we could have for example, the annual cash flow And that's going to happen each year. So this equals the annual cash flow that we calculated up top, the 199,640. That's going to happen in year 1. And I'm going to say it happens in year 2 by just saying equals of that same number. Happens in year 3. And I'm just going to autofill that over to year 4. So that happens each year. And then we've got the salvage value. And that only happens in year 4. So that's going to happen in year 4. So I'm going to say this equals the salvage in year 4 that we're going to get back. Let's pick it up here. All right, and it doesn't happen each year. And then I'm just going to say the total then of the cash flows is going to be this total. So I'm just going to say this is the total of the cash flows for year 1. I'm going to autofill, put our cursor on it, autofill across. There's our total for the cash flows for all years. So there we have that. Now we'll present value of 1 each year. So I'm going to say I'm going to present value this one 1 year out. I'll present value this one 2 years out. Present value this one 3 years out. Present value this one 4 years out. Also note that as we present value these, we're present valuing the cash flows after the purchase. So we didn't present value the cost because the cost happened in year 0. So in this case, we're just present valuing the cash flows after the purchase. The cost, $499,000 in this case, is something that we would put. It would be not needing to be present valued. The cash flow would have happened or been going out in year 0. In other words, we would want to take a look at the present value down here of the cash flows and compare it to the initial cash flow we put out in year 1, which would be the $499,000 cost of the equipment. Okay, so let's go back into this. Now we're going to present value each one of these using our formula. We're going to do this with a function this time. Instead of using the formula box up top, we're just going to say equals present value. We'll double click on that present value, and then we'll enter according to this little item here. This is giving us a check. And once you get used to it, it's pretty nice to use. So I'm going to say the rate first is going to be 0.07. So that's going to be our rate that we're using, comma, so that's not a comma, comma, and now we're on, see how it highlights the next one. So now we're on NPER, which is actually the number of periods. So how many periods are there? So I'm going to scroll, and in this case, there's 4 years, but this amount is only 1 year out. So we're looking for, this is the cash flow 1 year from now, 1 year later. So this is just 1 year out, comma, and then here's the tricky part where we have the payments. We're not talking about an annuity here. We're talking about one payment 1 year out. So I'm going to say that's 0, comma, and then we're going to pick out the future value, which is this amount 1 year later. So there we have that. It's a negative, so I'm going to go back into it, put a negative in front of the P, and flip the sign. So there we have. Now I'm going to do the same thing for year 2. Equals, now we could, I'll show you how to autofill this across as well, but I'm just going to retype it in for practice here. So we're going to say equals PV, double click the present value, the rate is first, the rate is 0.07, comma, then we have the number of periods, which is 2 in this case, because this is 2 years out. This is the 2 year out payment, comma, payments is going to be 0 because this is not an annuity, comma, and then the future value is going to be this amount. Tab, it's a negative. I double click on it, put a negative before the P, and enter. Now I'm gonna make it flip the sign before I start this time. Instead of hitting equals, I'm just going to put negative present value instead of equals present value. Double click the present value, pick up this pick up the rate, which is 0.07. comma, and then we're going to, the number of payments is 3, or the periods now, number of periods is 3, comma, and then the payments are 0, comma, and then the future value is going to be the 199,640. So there we have that item. One more time, negative present value formula, rate 0.07, comma, number of periods is going to be 4 now, comma, payments 0, comma, and then the future value 222,640, and enter. Now of course this one's larger because we had the salvage. And then if we were to sum those up, we're going to get our same number. So this time, this method works no matter, even if you don't have an annuity type of payment. So whatever, if you can imagine a very complex project, breaking out the cash flows for each year and then adding them up in this case. Now note, it does have some assumptions that the cash flows at the end of the year for one. Also, you can, if we wanted to basically copy this across, we could do that as well. So in other words, if I was to delete these three and autofill this across, because I put the years up top, if we autofill across, it'll pick up those numbers as well. In other words, it's picking up the correct year up top, this number, and we hard-coded the rate. So we can make these tables pretty quickly once you get good at it. The other way you might want to do it, and I actually prefer this way, is to have the years in a linear format. So I don't know why I prefer this, it's basically the same, but you could say the years are this way, and then we could say total. And then we're going to have our annual cash flows now, which are going to be equal to, see they're up in this format up here. Now I'm just going to bring them down vertically. There's our annual cash flows. The salvage value happens in year 4. So that's this number. We're just converting the table. And there we have that. And then if we total up this way, this is just another format you might see the table in. Again, I prefer it personally. And so then we have these items, and then we can present value on this format on the column. So same kind of present value calculations. We're going to say this equals this. Let's say negative present value of the rate 0.07, comma, and then 1, and then we're going to say comma, no payments because it's not an annuity, comma, and then we'll pick up this amount. Doing this a little bit faster, negative present value, and we're going to say 0.07, comma, number of periods 2, comma, payment 0, comma, and then future value this amount. Let's do it a couple more times. Negative present value, double click. Whoop. Present value, double click. We'll pick up the rate 0.07, comma, number of periods 3, comma, whoop, comma, and then the payment is 0, comma, future value is this item, and close that up one more time. Negative present value, double click on it, rate 0.07, comma, number of periods 4, comma, payment 0, comma, future value this item, and close it up. And then if we sum these up, I know I'm doing this fast, but we've repeated this a few times. So we're going to have the sum of these items, and then we get the same number. We just made it vertical. And again, if you set up the table this way, you can also, I'm going to delete these, autofill it down, right? If I autofill this down, I'm picking up these cells, I'm autofilling it down, and it's picking up the correct year because of the format of the table. So therefore, you can actually do these tables pretty quickly, and they give you a lot more detail in terms of the totals per year and the sums of what what the cash flows are, if you want more detail on what the cash flows are, and then the present value each year. And I think that's often worth the time for longer projects.